Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Innodata.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators. VIP indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10K is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
Okay, so with that out of the way, imagine a stock just, casually blowing past NVIDIA and Micron, right in the absolute middle of this huge AI boom.
Oh yeah, it's wild.
For anyone watching the market recently, it was completely impossible to miss what just happened with Innodata.
It was an absolute explosion. We are talking about an 86% single-day surge.
Insane.
Right. It hit all-time highs right after they delivered this massive Q1 earnings beat for 2026. But honestly, 86% at the closing bell doesn't even tell the whole story.
No, it really doesn't.
At one point intraday, the stock was up over 101%.
Which is just staggering.
If you want the textbook definition of a parabolic move, well, this is it.
Exactly. Which brings up the core tension we need to figure out today for you, the listener. Because when you see violent price action like that, the analytical side of my brain immediately starts flashing warning signs.
Naturally.
We have to ask, is this just a short-term speculative squeeze? Like, are retail traders just blindly piling into a momentum name? Or, has the market suddenly woken up and realized it completely mispriced a foundational AI data company?
And that is exactly what we're going to figure out. To really understand if this is a flash in the pan or a structural shift, we need to look at what they actually do.
Or let's move into the wealth building context. Because understanding where a company fits into the broader technological shift is how you build an actual long-term thesis.
Exactly. When we talk about building long-term wealth, especially in the tech sector right now, it's incredibly easy to get blinded by the massive hyperscalers.
The ones actually building the models.
Right, the companies building and branding the large language models. But Innodata matters for a long-term growth-oriented portfolio precisely because they don't build the models themselves.
They do the behind-the-scenes work.
Yes, they provide the foundational picks and shovels that make those models actually function in the real world.
Let's pause and define what those picks and shovels are, because the terminology in AI gets really dense really quickly. We're talking about things like pre-training data and post-training alignment, right?
Right. So to explain that simply, pre-training data is the initial diet you feed an AI to teach it how to understand language.
But that raw data is pretty messy, I'd imagine.
Oh, very messy. And that is where post-training alignment comes in. That's essentially teaching the AI manners and logic.
Yeah.
It's the process of ensuring the model's outputs are actually helpful, accurate, and aligned with human intentions, rather than just spitting out random, statistically probable sentences.
Which we've all seen happen.
Exactly. And finally, you have model evaluation, which is testing it rigorously before it ever goes live.
So without this entire pipeline,
a large language model is basically just a very expensive, highly hallucinating calculator.
I love that. I look at it like this. If large language models are the massive, high-horsepower engines of the future, Innodata is running the oil refinery.
That is a great analogy.
Yeah, like if the raw internet is crude oil, it's full of sand, water, and impurities. Pumping that raw, scraped internet data directly into an AI model means the engine knocks, it breaks down, and it hallucinates. Innodata is the chemical process pulling all those impurities out so you're left with high-octane rocket fuel. But here's my pushback. And this is something anyone managing risk for their portfolio needs to consider. Is this actually a buy-and-hold wealth compounder, or is this a cyclical tech play that has a shelf life?
Why would it have a shelf life, though?
Because as these models get exponentially smarter, there's a very real theory floating around that they'll eventually learn to train themselves.
Ah, the synthetic data argument.
Right. People talk a lot about synthetic data, AI generating data to train other AI. If synthetic data eventually replaces human annotated data, well, don't the refineries get left behind?
That's a really great question, and it's a major debate in the industry right now. But here is why the thesis for Innodata being a wealth compounder holds up. The complexity of the data required is scaling just as fast as the models themselves.
Okay, how so?
Well, think about it. 3 years ago, data annotation meant having humans identify pictures of traffic lights and crosswalks.
The classic PCHA stuff.
Right. But now, it's about complex reasoning, agentic behavior, and highly specialized domain knowledge.
Like medical or legal data.
Exactly, like having actual doctors annotate medical journals or lawyers structure legal frameworks for the AI. You can't just use synthetic data for that yet, because synthetic data degrades over time if it isn't anchored to ground truth human expertise.
It really needs that human anchor.
It absolutely does. It requires a constantly evolving, highly sophisticated data infrastructure.
That makes a lot of sense. You make a strong case for them being a critical infrastructure play. But, narratives don't pay the bills.
No, they don't.
If they are truly the oil refinery of the AI boom, that should be bleeding into their financials. Now let's look at the fundamentals, because narratives are great, but the balance sheet is where the truth actually lives.
And the truth in their Q1 2026 numbers is nothing short of spectacular. They reported record revenue of $90.1 million.
Wow.
Yeah, that's a 54% increase year over year, but the top line isn't even the best part. On the bottom line, their adjusted earnings per share came in at 42 cents.
And let's put that 42 cents in perspective for you, the listener. Wall Street consensus was sitting way down at 17 to 23 cents.
They completely blew past it.
They didn't just beat estimates, they completely obliterated them.
Exactly. Adjusted EBITDA nearly doubled, growing 96% year over year to $25 million.
Which shows massive operating leverage.
Massive.
Those growth numbers are undeniably impressive. But, whenever I see explosive top-line growth, I immediately zero in on the margin of safety. Like, what happens if the music stops?
Right, you have to.
And I have to admit, looking at their financials, they are built like a fortress right now. They ended the first quarter with $117.4 million in cash and short-term investments.
That is a huge jump.
Yeah, massive jump from the $82 million they had just at the end of last year.
They've turned into a cash-generating machine, honestly. Their operating cash flow was over $37 million in the first quarter alone.
Which gives them incredible flexibility. And more importantly, they have zero debt. Plus, an untapped $50 million credit facility.
That's a huge safety net.
Right. If you're managing a portfolio, you know that in a market environment where borrowing costs are still a major factor, having that kind of liquidity without the risk of shareholder dilution is massive. But I have to throw some specific pushback on these fundamentals.
Go for it. Let's hear it.
They are reporting adjusted gross margins of 47%. That's a 400 basis point expansion from where they were.
Yeah.
Now, historically speaking, data annotation is an incredibly labor-intensive business model. Like, if you need 1 million medical documents annotated, you usually have to hire armies of people to sit at desks and read every single page.
Which is super expensive.
Exactly. So how on earth is a 47% gross margin sustainable in a labor-heavy services business?
Well, that right there is the exact misconception management is trying to break, and it's the absolute core of the fundamental bull case. Innodata is actively decoupling their revenue growth from their headcount growth.
Okay, wait, explain the mechanics of that to me. Because if they aren't hiring more people, how are they doing the work?
They're doing this by transitioning from a pure services model to a platform model. They are relying more on their own proprietary software platforms and off-the-shelf datasets, rather than just brute forcing the work with human labor.
So the software does the heavy lifting.
Think of it like this. Instead of a human reading a document from scratch, Innodata's internal AI pre-labels and structures the data.
Oh, I see.
Yeah, the human expert is then only stepping in to verify, correct edge cases, or add high-level reasoning. This makes their workforce exponentially more efficient.
That's really smart. It turns a labor cost into software operating leverage.
Exactly. And because of this specific dynamic, management felt confident enough to raise their full-year growth guidance to 40% or more.
40% or more. That blows past their previous 35% guidance and totally eclipses what analysts were expecting. So Q1 is undeniably stellar, and the margins make sense when you understand the platform shift.
They really do.
But the market is a forward-looking voting machine. That brings us to the catalyst timeline. What is going to drive the next leg of growth now that this spectacular Q1 quarter is fully priced into the stock?
Well, the single biggest catalyst is a blockbuster announcement they made regarding a new engagement with a major big tech customer.
Who is it?
They haven't named the giant, but they expect this single engagement to add $51 million in revenue in 2026 alone. Let that sink in. That instantly makes this unnamed tech giant their second largest client.
$51 million in a single year from one new contract. I mean, that isn't just incremental growth. That is a massive needle mover.
Absolutely. And the proving ground for that contract is going to be their Q2 earnings report coming up in early August. Wall Street is going to be watching that print like a hawk to ensure that the $51 million contract is ramping up exactly on schedule.
Makes total sense.
But beyond just new customer contracts, there's a major product catalyst on the horizon. They're commercially launching what they call their evaluation and observability platform.
Okay, let's stop and translate that for listener. Observability platform. What does that actually mean in practice?
Think of it as a control plane for agentic AI systems.
And let's pause on agentic for a second, too. When we talk about agentic AI, we aren't just talking about a chatbot answering a trivia question anymore, right? We're talking about AI actually executing real-world tasks.
Spot on. An agentic AI is one that acts as an agent on your behalf.
Like booking things online.
Yeah, it might navigate a website, book a flight, or even execute a complex financial trade. Now, if an AI is just chatting with you and hallucinates a wrong fact, it's annoying.
Right.
But if an agentic AI hallucinates while managing a supply chain or executing trades, well, it's catastrophic.
That is a great point. So where does Innodata fit there?
Innodata's evaluation and observability platform is the manager sitting above the AI, monitoring its actions, evaluating its reasoning steps, and ensuring it doesn't go off the rails.
Got it. It observes the AI to keep it safe and effective.
Exactly.
That sounds like an absolutely mandatory piece of infrastructure for any enterprise deploying AI.
It is. And right now, they already have a $1 million initial contract with a major hyperscaler just for this platform, plus 15 active evaluators currently using it.
Which is a solid start.
All right.
And if we connect this to the macro picture, their timing is incredibly fortunate.
Very.
If you look at the broader geopolitical and semiconductor landscape, we're seeing eased U.S.-China tensions recently. Combine that with the massive, unyielding sales of NVIDIA's new H200 chips.
The hardware just flying off the shelf.
Exactly. All of that macro data practically guarantees that the big hyperscalers are going to continue pouring billions upon billions into capital expenditures. They have the chips, so now they have to keep training these models to justify the hardware spend.
It's an arms race.
It really is. And here is a speculative catalyst that really caught my eye while I was reviewing the notes. The CEO specifically mentioned on the call that they have, quote, several potentially large programs we have not yet included in our forecast.
Which heavily implies they might be deliberately sandbagging that newly raised 40% guidance.
Exactly. It's classic under-promise and over-deliver management behavior. If they are already officially guiding for 40% growth while keeping potentially large programs completely off the books entirely, the upside surprises in Q3 and Q4 could just keep coming.
Oh, absolutely. Now let's pivot to the chart, because we've talked about the fundamentals in the story, but translating all these fundamental catalysts into actual price action is where things get really wild.
And if you're looking at this chart at home right now, I mean, it is a sight to behold.
The breakout was massive, and the volume was extreme. As we touched on at the start of the deep dive, the stock skyrocketed 101.3% intraday.
It's just wild.
It hit an all-time high of $114.77 before the algorithms and profit takers finally settled it down at $103.83.
Still an incredible gain.
Oh yeah, over the past month as a whole, it has gained 117.7%. It is casually blowing past other market darlings. Even a giant like Micron had a massive 90% rally recently, and Innodata just cruised right past it without breaking a sweat.
Let me put on my cautious analytical hat for a second here.
Please do.
Because when you see a stock gap up that violently, it implies a couple of distinct market mechanics are happening simultaneously.
The technicals.
Right. First, you have a massive short squeeze. Anyone who was betting against the stock expecting poor earnings was suddenly trapped. As the price surged, they were forced to buy shares to cover their losing positions, which acts like pouring gasoline on a fire.
That forced buying pressure is intense.
Super intense. And second, you have serious institutional accumulation. Retail traders trading on their phones do not move a stock of this market cap that far, that fast, on that much volume.
You are entirely right. The volume profile tells you the big mutual funds and hedge funds are stepping in and fundamentally repricing the company's valuation based on that new 40% guidance.
But, and this is a major warning for you, the listener, if you're looking at the chart today trying to find an entry, the stock is currently entering a cooling off and consolidation phase. Entering a position right after a parabolic 100% gap up introduces severe near-term volatility risk. For sure. You have momentum traders who rode the wave taking profits. You have technical gaps on the chart that historically might need to be filled.
It needs space.
Exactly. The price structure needs time to build a new, solid base of support. Buying the absolute top of a 100% single-day green candle is historically a very dangerous game, no matter how good the fundamentals are.
Definitely. So what does market sentiment look like? Because it's one thing for the chart to look a certain way technically. It's another entirely to see how Wall Street analysts are actually digesting this massive structural move.
Exactly. Are the professionals backing up the price action?
They are, and the mood is overwhelmingly bullish. Wedbush analyst Dan Ives, who is arguably one of the most prominent and closely followed voices in the tech space, maintained his outperform rating on the stock.
And the price target.
He bumped his price target significantly up to $100.
That's a huge stamp of approval.
It really is. And if you look at the broader consensus, targets generally sit in the $93 to $95 range right now, with at least one aggressive high target stretching all the way up to $111.
The narrative on Wall Street is clearly shifting from skepticism to belief. And I do see the institutional flow diversifying, which is healthy. The fact that revenue from their other big tech customers, meaning clients outside their single primary cash cow, grew a staggering 453% year over year is absolute proof of that.
That number is just incredible.
Right. Let's do the math on that. 453% means their secondary business is exploding. But I have to ask you, is the sentiment getting dangerously euphoric?
How do you mean?
Well, when a mid-cap stock is making daily headlines for beating a titan like Micron's rally, you have to wonder if retail investors are simply chasing the institutional momentum way too late in the game.
I see what you're saying.
Extreme bullish sentiment can sometimes act as a contrarian indicator if expectations become literally impossible for the company to beat in the next quarter.
That is a highly valid concern. Euphoria is dangerous. But the sentiment right now seems grounded in the actual mathematically proven revenue acceleration.
True.
That 453% growth in other big tech clients proves their thesis is resonating across the entire industry. They aren't the one-trick pony. They are becoming an industry standard.
Fair point. But let's dig into the flip side. Now let's talk about the risks. Because no thesis, no matter how exciting, is bulletproof.
Absolutely. And any smart wealth strategy requires looking at the bear case.
Exactly. And the vulnerabilities in this bull case are significant if you look closely.
Yeah.
I want to really hammer on their customer concentration risk. Let's look at the first quarter data again. One single customer made up 56% of Innodata's total revenues.
That is a big chunk.
And a second customer made up 17%. I think it's over 70% of their entire revenue stream is tied directly to just two corporate clients.
Wow. Okay.
If that primary customer suddenly changes their internal AI data strategy, delays a quarterly budget, or decides to take the annotation work in-house to cut costs, Innodata's financials would be utterly devastated.
That's a very fair risk to point out.
And here's the wild paradox of that amazing new $51 million big tech contract we talked about earlier. In the near term, adding that massive contract actually amplifies their absolute exposure to their top two clients rather than diluting it.
Because that one client just got so much bigger.
Right. It makes the company even more top-heavy.
I see the math there, and concentration risk is always a red flag. But I have a strong rebuttal to how we should interpret that.
Let's hear it.
You have to look at the absolute dollars flowing in, not just the pie chart percentages. Yes, the largest customer is a terrifyingly huge slice of the pie, but that largest customer's absolute dollar spend is still growing rapidly.
So the pie itself is getting much bigger.
Exactly. The concentration you're seeing is a byproduct of rapid organic sector expansion, not a shrinking customer base.
Okay, I can see that.
When your biggest clients are throwing tens of millions of new dollars at you every single quarter, your concentration percentages will naturally look skewed. But frankly, having tech giants throw money at you is a very high-quality problem to have while you build out the rest of your platform.
I will concede it's a good problem to have for now, but I still want to bring up the valuation reality check, because this is where investors get burned.
The multiple.
Yeah. After this parabolic 86% surge, the stock is currently trading at a forward 12-month price-to-earnings ratio of almost 70, specifically 69.64.
That is steep.
To anchor that for you, the listener, the industry average PE is around 26. Let's unpack what it means to be privileged for perfection. When you trade at a PE of 69, the market is assuming you will execute flawlessly for years.
And if they don't?
If there is even a minor execution misstep, or if those labor-intensive data annotation costs creep back up and compress that beautiful 47% margin, we're going to see a violent multiple contraction.
Which means the stock price tanks.
Exactly. When a stock trading at 70 times forward earnings misses a beat, the floor drops out very, very quickly.
It is priced at a premium, without a doubt. It is not a value stock. But again, you have to look at what you're buying.
Right.
Those 47% gross margins and 28% EBITDA margins demonstrate immense pricing power. The market is giving them a 69 PE because they are not being viewed as a traditional low-margin data service peer anymore.
The market sees them as software.
Exactly. They are being valued as a high-margin software infrastructure platform, and software platforms with sticky ecosystems justify premium multiples.
So with everything on the table, what's the final verdict?
Well, based on all the research, the fundamentals, and the catalyst, we are looking at a bullish score of 8 out of 10.
8 out of 10, nice.
Yeah. The elevator pitch is this. Innodata is a premier artificial intelligence data infrastructure play that is currently firing on all cylinders. They have a pristine balance sheet with zero debt.
The dream balance sheet.
Right. And the addition of a $51 million big tech customer, plus the commercial launch of their proprietary agentic AI observability platform, completely validate their expanding market share and their massive operating leverage.
But the target horizon here isn't just a quick swing trade or a fast flip, is it?
No. The target horizon based on this analysis is a multi-year hold. The fundamental goal here is to capture the massive long-term scaling of their agenting platform and let that customer diversification naturally play out over the next few years.
One final thought for you to mull over as you analyze your own portfolio and look at this space. We spend so much time in the media obsessing over the models themselves, the parameters, the compute power, the billions being spent on data centers and graphics processing units.
Yeah, absolutely, the shiny objects.
Right. But historically speaking, if you look back at massive technological gold rushes, the most durable fortunes weren't usually made by the prospectors digging in the dirt for the gold. They were made by the people selling the pickaxes, the denim jeans, and the shovels.
Which is exactly what we're talking about here.
Exactly. If refined data is the new gold of the 21st century, the proprietary tools and platforms required to refine it might just be the most valuable assets of the entire era.
That is a great way to look at it.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow 100 to $10K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.